Here to discuss what to expect from the markets this month, Sarah Ketterer, CEO and Portfolio Manager at Causeway Capital Management. Our guest host for this and the next hour, Mohamed El-Erian, Allianz Chief Economic Advisor. That's a genuine smile. You were only as good as our last victory, right? Yesterday, pretty good.
3 out of 4.
Nice runs, nice offensive production. I told you there would be some spots where I think you're 3 above 500 now with the math.
We are
3 above. Reds just anyway. Sarah, let me. I'll start with you because I think I can understand easily what you're saying here. If you have one thing to tell clients right now, it's own value as opposed to growth, and your day will come. Recession or no recession, value's the place to be right now.
Definitely. My colleagues and I believe value is already priced in. It's priced in.
Priced in recession, even.
It's priced in something horrendous. Look at the banks trading in Europe at half a book value or less. They're pricing in a crisis akin to 2012, the Eurozone crisis, or even 2008, but with 3 to 4 times as much capital. Look at the energy stocks globally. They're crushed. They trade in the U.S. It's mid-single-digit PE multiples. You could take any value portion of equity markets and find they've already discounted the worst Brexit. They've discounted the trade war. Markets are amazing discounting mechanisms in that respect. So this has to be a great time to buy value, and you get yield. It's ironic that European stocks, so many of the great value stocks, have yields that are 5 or 6% from companies that have plenty of free cash flow. But the bond yields, as you know, are negative in that part of the world. There's
some yields here in the S&P among value stocks that you don't even have to go to Europe to get the 5 and 6% necessarily, right?
Exactly. And will those dividends get paid? That's the question.
Right.
And that's what analysts do. That's what we look for, to see if these companies have the ability to cover that dividend and grow that dividend.
So if the market were to enter a bear phase because of a recession, you'd still be able to buy value right now, even if we're facing that. You don't need to worry about buying now because you figure even in a 20% overall correction in the S&P, these are still cheap enough now to buy.
Absolutely. Like, price discovery is an important tool, and it's sort of been abandoned with passive investing. But finding companies that have the financial strength, that's what we do at Causeway. We insist upon financial strength. So those companies can weather the storm. We saw them hold their ground through an 2008 crisis, and these meltdowns, they happen. That's what markets are supposed to do. We just haven't had one in a long, long time.
What's the catalyst, though, for the European banks to do better? I mean, and even if you own a bank that you think is a financially strong one, are you comfortable that there would be no knock-on effects if Europe deepens in a recession from a Commerzbank or a Deutsche Bank and the exposure they might have to unknown things like derivatives or whatnot?
Well, a systematic crisis would be a problem. This seems very unlikely given the level of capital. There's certain banks to avoid. You've just mentioned a couple, but there's some great ones out there, like UniCredit in Italy. Italy is considered to be a basket case by the markets, and yet seeing companies completely revolutionize their balance sheet, get rid of bad debts, and get ready to, as the U.S. banks have done, to start returning more capital to shareholders. It's very exciting, and it's certainly not priced into a bank like that, trading at 40% of its book value, less goodwill. They're almost giving it to you on a silver platter. And like, the time to buy won't be after we have a recovery. And what will cause this? Just having rates stop falling. They can't fall forever, and they never do.
What do you think, Mohamed?
So I don't disagree that if you look at valuations, it's absolutely compelling. And you can go further. Look at emerging markets versus the U.S. It's even more compelling. But that's been true for a while. And if you step back and ask, what did we learn over the last 24 hours, before we dive into, Steve, the Fed and the data on the U.S., because there's a lot, we learned 2 very important things. One is the U.S. is influenced by what's happening in the rest of the world. The dollar strength yesterday, the yields today, it's all about the rest of the world. It's not about us. So we must take into account the rest of the world. The second thing we learned very powerfully is that it's now a complete circle between bad economics and messy politics. It used to be bad economics contaminating politics, and then central banks would short-circuit the transmission back. Now you've seen it in Europe, you've seen it in Asia. It is bad economics impacting politics, messy politics undermining economics, and next thing you know, a global recession, the probability of that goes up. So the only thing I have is not whether it makes sense over time, is when do you put the trade on? Because these macro factors are really powerful.
The key is to put that trade on when the pain is acute, because when we know we're going into recession, those value stocks will start to discount the recovery. This was very much true in late 08, early 09. We saw those stocks moving ahead. They were tremendous performers then, and we expect they will be again.
And you don't Mohamed, did you see the William Cohen piece in the New York Times this weekend about
only the Fed can save us?
Well, it was only the Fed can save us, which is another conversation from the one I want to have.
Okay.
Which is that there's all kinds of bodies buried in the debt market, very much the way it was. Now, I think Mr. Cohen has been a bit of an alarmist in some of these regards over time. That said, we know that the banks look pretty good, and that's part of what our guest over there is talking about. However, it's the non-banks banking operations that I think are the things that keep regulators up at night. There are hedge funds providing financing, right? They are designed to create private lending onto different companies. All sorts of things. Pensions are in these hedge funds. How much do you worry about this, that there are bodies buried in the lending market that are leveraged that create a problem if there's weakness in the economy?
So first, I'm really glad you're saying regulators worry about this, because it's taken them a long time to realize that risk has morphed and has shifted from the banks to the non-banks.
From the banks to the non-banks.
You're citing the tip of the iceberg. Look deeper. The proliferation of ETFs on illiquid asset classes. The overpromise of liquidity to the end users. People going way beyond their mandate.
So, Mohamed, though, my question is, if that blows up, what does it mean?
Well, what we're going to see, the good news,
what does that look like?
The good news, it's not in the banks. So it's not a systemic risk.
Like the sickly European banks may be the safest place to be.
Okay, but
absolutely.
But remember one thing: when you overpromise liquidity and the investor can't sell what they want, they sell anything they can sell. We've seen this over and over again. The taper tantrum was an example of that in 2013. So there's contagion risk in the markets.
All right, Sarah, thank you.